Good day, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Tuesday. It's August 16th. This is where my mind is. My mind is still in April, just to show you how crazy I am. It's August 16th. Today is the day that my daughter, my middle daughter, actually leaves for college, believe it or not. Not a good day for Father Roger, not at all. Anyway, it's about 8:10 in the morning. The market's going to open up in about an hour and 20 minutes to be specific with you. It looks like we're a little soft overnight. Now, just to give you a couple of things that are on the table. On Monday, we had the housing market index. That report came in below 50. Anything below 50 is telling us that the housing market is cooling off substantially. Now, why is this report important? Because today we have housing starts and permits in about 19 minutes to be specific. And then we have industrial production. So these reports are really important to give us an idea of whether housing starts are really cooling off, or if the demand for housing is still there in light of the inflationary pressure and the potential recessionary pressure that we are seeing. It'll be a very interesting report, and industrial production will be a very interesting report. The biggest report of the week is going to be retail sales because that makes up 2/3 of the economy. But it'll be very interesting to see how the housing starts and the industrial production report does. If you're in my VIP room, make sure you come in today at 3 p.m. We're having a class today, by the way. We're having my... this is going to be a very cool class. I'm going to be talking about energies. It's going to be very cool. It's happening at 1. But at 3 o'clock, we're having at my VIP room where I'll be talking about it. But don't miss the energy class. It's happening. Follow the link below this. So let's talk a little bit about this. So housing starts, industrial production, a few things that we need to know about. Earnings, okay? Earnings. So Walmart tops expectations. Americans continue spending. Do you see that? I love that. Walmart earned $5.15 billion, $1.88 per share. They were excluding or $1.77, easily beating the 162 per share fact set. That's very positive for spending. And that's telling us that the Fed can in fact raise rates more and we can handle it, which is a positive thing, because if the Fed can raise rates and we can handle it, that means there's less chance of us going into a recession. And by Fed raising rates, what they're trying to accomplish works. In a simple way, that explains it. So if you think this was good, how about this? Home Depot, look at that. Record profits, revenue sticks to outlook. Interesting, right? And I mean, these are some major stores. I mean, these stores are a great measurement of our economy. Walmart, Home Depot, hello. So revenue for 3 months rose 6.5%, topping projections of 35 by a little bit, not by too much. But they did break it. While the number of customers' transactions fell 3%, the amount of shoppers per transaction rose 9.1%. They earned $5.17 billion, $5.05 per share, topping $4.95, and definitely topping the billion. Now, I do believe the market's overbought a little bit, and I think things are going to be cooling off, but I think that's normal ebb and flow. If you look at the put-to-call ratio, we're still relatively bearish. We have not gone to the below 80 level since March. So that's pretty significant. That means market still has some gunpowder left to the upside. Volatility, though, appears to be increasing. Look at the divergence. Up, down. That's telling me that volatility has bottomed out and we may see some downside. But not because of the fundamentals. The fundamentals are actually getting better. It's because of the technicals. Let me show you what I'm talking about. Look at the Nasdaq 100. This is the number of stocks trading above the 50-day moving average for the Nasdaq. It's at the second highest level we've seen. The highest level we've seen before this was the recovery from the COVID. That's the bounce back from the COVID, and now we're seeing another one. That's the highest we've seen. Look at that. I mean, we had one in June 2009, but that's like the highest level we've seen in a very long time. Now, that would be great, and that would be bullish if the 200-day moving average was accommodating us. But look at the 200-day moving average, only 46% of stocks. Look, we're barely up. So if this was to turn down right now, it wouldn't even be a big deal. Look at how many times we've been here. Like every time, right? So I would be much, I'll say that a few more times, much more focused on the number of stocks trading above the 200-day versus the 50-day. And look at consumer discretionary, 95, 22. I mean, look at this. This looks like we're in the biggest bull market in history, right? And then when you look here, you will see that we are not. We're barely up. So I don't know if this can maintain going higher with the number of stocks in the 50-day so high. It's almost to a point where it needs to go down before going up, no matter what. It's just too overbought in the short term. And therefore, I think consumer stocks, infotech, anything with less than 50 here, like communication services, real estate, materials, information technology, financial, consumer discretionary, can go off the rails. Matter of fact, even in the broad S&P, only 46% are trading above. So that's telling us the markets are very, very vulnerable right now. It doesn't mean we're going to make new lows. I like the way earnings are coming out, but it may mean exactly what the bond market is doing, which is going back into its range, while a lot of sectors got out of their range a little too much too fast, probably because of earnings. But as long as the bond market can stay choppy, it'll ground the stock market, and it'll reduce volatility, and it'll give us hope that the worst is behind us. Now, as far as news, retail sales will give us some more hope, and the jobless claim, it'll be very interesting to see how that goes. But today, housing starts and industrial production. Let's talk a little bit about global economy. Global shares rose mostly Tuesday despite investors' risk reflected in negative economic data out of China, and analysts warning that volatility may lie ahead. I believe that too. In Japan, recent economic activity shows a recovery, but high rate of COVID are fueling fears that people will hold back on travel and other activity. By the way, the recovery from COVID in terms of travel has recovered only about 20 or 25% since post-pandemic, since prior to pandemic. Just wanted to kind of give you guys heads up. Markets reacted to news overnight that Chinese central banks cut a key interest rate, acknowledging more needed to be done to shore up its economy. The move is the latest warning for markets already on the edge over record high inflation and fears about recession. But Americans are spending. China is the world's second largest global consumer of crude oil, so the news weighted on energy prices. And energy slumped 2.9%. We'll see how that goes. Global investors are worried that the U.S. Federal Reserve could hit the brakes too hard and send the economy into a recession. Any signal that inflation could be peaking has helped ease some worries. That's what we saw with the CPI and the PPI. Investors are keeping a close watch on inflation and how it's infecting businesses and consumers. Spending has slowed, but not that much. And the broader economy has already contracted for 2 straight quarters. Several big retailers will give investors more details. They already did, and those numbers are really good. You see, just as we hear some bad news, we start seeing good news. Home Depot and Wall Street, they already reported, and as I showed you, better than expected, record profits, and tops expectations. What can I say? Again, sectors. Utilities, for the first time, is now overtaking energy. Energy, technology, and consumer discretionary are in 3rd and 4th spot, but on a monthly basis, they are still in the top spot. But I'm telling you this right now. These 2 sectors are overdone to the upside. They need to cool off. It's too much. As a matter of fact, these 3 and maybe even 4, financial is just getting to that hump right now. But the bottom line is, look at energy. Energy starting to make its way back up. Materials, I would be very, very cautious. I still like healthcare very much, and I like consumer staples. To me, those are the most defensive sectors. Now, I would be focused on energy. I like energy a lot, and I think energy is going to be making a comeback because we still have inflation, but we're not in a recession. So I want to tell you something important. Just a final reminder, I'm going live at 1 p.m. Eastern time today, and I'm covering some of the pretty big macro topics, but it's very, very actionable. Here's what I'm going to talk about. My biggest prediction since nailing the bottom of COVID crash within 5 days, why billionaires are piling into this one little known sector in preparation for what might be the worst crisis in the coming winter, what experts are saying about a rare 20-year super cycle, why parking your money in the S&P 500 over the next few months could cause you to miss the most explosive trading opportunities. Folks, this is as meat and potatoes as it gets. It's going to be focused on the energy market. You guys are going to love this. When I saw the research, I absolutely love this. I love. You guys will love this. You can't miss it. I forbid you from missing out. It's happening at 1 p.m. Eastern time, and I haven't been this excited in a long time. And I get excited all the time. I promise you don't want to miss the session. If you can't find the link, follow the link below this video in the YouTube channel. Like us, subscribe to our videos, send comments, love letters, and all that good stuff. I'll talk to you later. Have a great day. Keep yourself out of trouble. We're going to churn. It may happen slowly, but this market isn't going to continue moving upside with the momentum levels of where they're at. It's a very strong improbability. We need a major pullback. Talk to you guys later. Send me love letters. Support at marketgeeks.com. Bye.